Welcome to the DX Today podcast, your daily deep dive into the AI ecosystem. I'm Chris, and joining me as always is Laura.
Great to be back with you, Chris, because today we get to talk about one of the most consequential and quietly seismic shifts happening in the AI economy right now. And I think most people completely missed it in the noise of the last 2 weeks.
You teased this before we started recording, and I want to hear where you're taking it, because the headline you flagged involves Meta, Broadcom, gigawatts of silicon, and a board-level conflict of interest resolution that hints at how serious this really is.
Exactly. And the specific moment I keep circling back to is April 14th, when Meta and Broadcom formally extended their partnership to co-develop the next 4 generations of MTIA chips with a deal structure that runs all the way through 2029.
So for listeners who haven't been tracking the custom silicon beat, MTIA stands for Meta Training and Inference Accelerator, and it is Meta's in-house alternative to buying Nvidia GPUs for the massive volume of AI inference workloads inside Facebook, Instagram, WhatsApp, and Threads.
Correct, and the headline number everyone latched onto was the 1 gigawatt initial commitment, with a multi-gigawatt roadmap that is likely to scale into the high single-digit gigawatts by the end of the decade if current deployment patterns hold steady.
A gigawatt of chips is not a phrase we used in semiconductor conversations 5 years ago. So help people understand what that actually represents in the real world, because most listeners don't have an intuition for that scale of compute.
A gigawatt of AI accelerators is roughly the power draw of a mid-sized American city, and it translates into hundreds of thousands of chips humming inside massive data center campuses that can each cost $5 to $10 billion to build and energize.
And one extra wrinkle that caught my eye was that Hock Tan, the Broadcom chief executive, actually stepped off Meta's board the same day to avoid a conflict of interest, which tells you something about the magnitude of the commercial commitment.
That detail tells you just how serious this partnership is, because you don't restructure a board seat unless the commercial relationship is about to get a lot bigger, a lot more formal, and a lot more scrutinized by regulators, auditors, and institutional shareholders.
Let's unpack the chip lineup itself, because Meta announced 4 distinct generations called MTIA 300, 400, 450, and 500, and they are coming at a cadence of roughly 1 new generation every 6 months.
The MTIA 300 is already in production and is optimized for ranking and recommendations, which was actually the dominant Meta workload long before generative AI took over the conversation, and which still drives the majority of ad revenue across their apps.
Right, because remember, before ChatGPT existed, the most valuable AI at Meta was still the model deciding which reel to show you next. And that workload never went away, it just got quietly overshadowed by the generative AI coverage in the press.
Exactly. And the MTIA 400 is the really interesting one because it was redesigned specifically for generative AI models and features a 72 accelerator scale-up domain inside a single rack, which is the same basic topology Nvidia uses for its highest-end training pods.
That scale-up domain language is important because it tells you Meta is building these not as individual chips, but as tightly interconnected pods that behave like one giant accelerator, which is the only way to run very large, generative models efficiently.
Meta has apparently finished lab testing the 400 and is now on the path to deploying it across data centers, with the MTIA 450 and 500 lined up behind it in a roadmap that extends well into 2028.
The cadence is what surprises me here, because a new generation every 6 months is incredibly aggressive, even by hyperscaler standards. And it implies Meta is absolutely not treating this as a side project or a hedge against Nvidia pricing pressure.
It also implies deep confidence in the Broadcom partnership because Broadcom's XPU platform handles chip design, advanced packaging, and the high-bandwidth Ethernet fabric connecting thousands of these accelerators together into functional clusters at unprecedented scale.
Let's talk about the performance numbers Meta shared, because those matter a lot when you're trying to justify walking away from the most dominant accelerator company on the planet. And Meta's investors are going to ask very pointed questions about return on capital.
The numbers Meta published were roughly a 3 times per chip improvement over the first MTIA generation, 6 times model serving throughput at the platform level, and a 1.5 times performance per watt gain, which is the metric that really matters in a power-constrained data center.
Performance per watt is the metric I really watch, because in a power-constrained environment, which every hyperscaler now absolutely is, every extra watt of efficiency directly translates into more inference capacity, lower operating costs, and essentially higher gross margin on every AI product feature.
And that brings us to the fundamental thesis underneath this entire move, which is that inference has quietly become roughly 2/3 of all AI compute by volume across the industry. And nobody really talked about that shift until it was already well underway.
That is a number that deserves more airtime, because for years, the narrative was that training the frontier model was where the real spend happened, and inference was essentially a rounding error that nobody in the financial analyst community bothered to model in detail.
That narrative has completely flipped. And once you have billions of users hitting a generative AI feature inside a consumer app, the inference bill absolutely dwarfs the one-time training run cost by an order of magnitude within the first year of deployment.
So if you're Meta and you're running models for 3+ billion daily users across Facebook, Instagram, WhatsApp, and Threads, the inference compute bill is essentially your new variable cost of revenue, and it scales directly with user engagement, rather than being a fixed capital expense.
And Nvidia GPUs, while absolutely magnificent for training frontier models, are priced at roughly 70 to 80% gross margin, which means every inference query Meta runs is paying a massive markup to Jensen Huang that ultimately comes out of Meta's own operating margin.
That markup is exactly what custom silicon is designed to attack, because Meta owns the stack, amortizes the engineering cost across hundreds of thousands of chips, and pays something closer to costs, plus a reasonable design and manufacturing fee to Broadcom and the foundry.
The key phrase industry analysts keep using is workload segmentation, where training stays on merchant GPUs because the workload changes constantly and requires general-purpose flexibility, and inference moves to custom silicon, where the workload is predictable and volume is enormous.
Now, I want to push back on one framing that I keep seeing in the headlines, which is this idea that Meta is somehow ditching Nvidia or replacing them entirely, because the reality is considerably more nuanced, and the numbers do not actually support that narrative.
That framing is definitely wrong because Meta has simultaneously committed to deploying roughly 6 gigawatts of AMD GPUs over the next few years, and is still buying millions of chips from Nvidia specifically for frontier model training workloads where flexibility matters.
So the honest framing is diversification rather than replacement. And the clever strategic insight is that each gigawatt of MTIA is one less gigawatt of incremental demand flowing to Nvidia, which over time absolutely reshapes the pricing power dynamic in the accelerator market.
Right, because NVIDIA's extraordinary growth story has always been built on insatiable incremental demand. And if hyperscalers collectively start satisfying their own inference demand internally, the growth curve necessarily flattens even if NVIDIA retains its dominant position in frontier training.
And Meta is not doing this in isolation, which is really the bigger pattern worth paying attention to. Because every major hyperscaler is running the exact same custom silicon playbook at roughly the same time. And they are all reaching similar conclusions about the economics.
Google has been doing this the longest with their tensor processing units, Amazon has Trainium for training and Inferentia for inference, and Microsoft has been scaling their Maya accelerator inside Azure data centers, with all three companies telegraphing aggressive expansion through 2028.
That pattern is why some analysts are forecasting NVIDIA's share of the inference market could drop from roughly 90% plus today to somewhere between 20 and 30% by 2028, which would be one of the fastest market share reversals in tech history.
That would be an extraordinary reversal in just 2 years, and it is why NVIDIA keeps emphasizing its software moat, the CUDA ecosystem, and increasingly its own move up the stack into full rack-scale systems, networking, and vertical AI platform offerings to defend margin.
Let's talk about NVIDIA's response because they are absolutely not standing still. And the Rubin architecture and the Blackwell Ultra chips are explicitly designed to make custom silicon economics harder to justify by pushing raw performance per dollar aggressively on each generation.
NVIDIA's counter is that a general-purpose GPU, if it keeps doubling performance every generation on a tight cadence, can stay ahead of a custom ASIC that was optimized for yesterday's model architecture and cannot easily adapt to tomorrow's.
That is actually a fair point worth taking seriously because model architectures are still evolving rapidly. And a chip designed in 2024 for transformer inference might be poorly suited for whatever new mixture of experts or state space architecture comes next in 2027.
And that is exactly why Meta is releasing a new MTIA generation every 6 months. Because the only way to keep up with architectural change is to iterate the silicon aggressively, which is a very different game from the historical 2 to 3 year ASIC cycle.
The 6-month cadence is really the secret weapon here. because it closes the architectural gap that normally favors general-purpose hardware over fixed-function custom chips in a fast-moving model landscape. And it is genuinely difficult for any other hyperscaler to match right now.
Broadcom's value in all of this is that they have the design methodology, the packaging expertise, and the networking chops to actually ship custom chips at that cadence, which almost nobody else on the planet can match at comparable engineering quality.
I want to dig into one more detail, which is the Broadcom Ethernet networking piece. Because for a long time, Nvidia's InfiniBand was considered the only serious fabric for large training clusters, and that networking moat was a huge part of their lock-in.
Broadcom has been quietly building Ethernet-based fabrics that now rival InfiniBand on latency and bandwidth, and Meta has been an extremely public advocate for Ethernet as the future of AI data centers, even contributing technology to the Ultra Ethernet Consortium.
So the picture we're painting is a full-stack alternative to Nvidia forming around custom ASICs from Broadcom, Ethernet fabric instead of InfiniBand, and open software frameworks like PyTorch and Triton instead of the proprietary CUDA ecosystem that Nvidia has spent 2 decades building.
Yes, and that full-stack alternative is the real threat to Nvidia, because it is one thing to lose some inference share on one workload type, and quite another to lose the integrated platform story that has been the real source of their pricing power.
Let's zoom out and talk about what this means for the broader AI economy. Because cheaper inference at scale changes the economics of every AI product in the industry downstream, not just the big 3 consumer platforms running their own custom silicon roadmaps.
If inference costs drop by 50 or 60%, which is plausible when you remove NVIDIA's margin from the equation, then suddenly every AI feature that was marginally profitable becomes aggressively profitable, and startups without their own silicon benefit from cheaper cloud inference too.
And the corollary is that features that were too expensive to run at scale, like always-on video understanding, persistent agentic workflows running in the background, or rich multimodal search, suddenly become economically viable for consumer apps with billions of users.
That is actually the quiet upside of this whole story, because the compute overhang has been the single biggest limiter on what AI products companies are willing to launch to billions of users, and removing that constraint unlocks an enormous amount of latent product innovation.
I do want to flag some skepticism too, because custom silicon has a long history of projects that looked incredible on paper, and then got quietly shelved when model architectures moved or when the engineering team underestimated the software and compiler work required.
Meta's own first MTIA generation was relatively modest in impact, and there have been hyperscaler custom silicon efforts going back a decade that never quite delivered on their original ambitions at scale because the software tooling and developer experience lagged the hardware.
The difference this time is the sheer capital commitment and the explicit multi-year roadmap through 2029, because you don't sign a 5-year deal of this magnitude unless you have very high conviction backed by real production data from the earlier generations.
And the other difference is that the workload itself is now large enough, predictable enough, and commercially valuable enough to justify the engineering investment, which genuinely was not true for inference workloads 5 years ago when generative AI was still a research curiosity.
So if I'm summarizing the takeaway for our listeners, the Meta Broadcom deal is not a one-off headline, but the clearest data point yet that hyperscaler compute is permanently restructuring around a 2-tier architecture of merchant training silicon and custom inference silicon.
And the company to watch now is actually Broadcom, because they are quietly becoming the essential design partner for every hyperscaler that wants to build its own custom AI silicon roadmap. And their moat in packaging and networking is genuinely very hard to replicate.
The stock market has already figured this out because Broadcom's valuation has reflected their custom silicon book of business for more than a year now. And Nvidia investors are paying much closer attention to the inference share erosion narrative than they were 12 months ago.
The final thing I want to leave people with is that this story is really about control, because hyperscalers have decided that depending on one supplier for their single most critical input is strategically unacceptable regardless of how good that supplier's products currently are.
That is a perfect place to land, because silicon sovereignty is the real theme here. And every company running AI at scale is going to be asking versions of the same question about who controls their compute supply chain over the coming years.
And we will absolutely be tracking how MTIA 400 performs in production once those deployments land, because that is the moment the custom silicon thesis either proves itself at scale or gets quietly walked back behind closed doors and glossy press releases.
That's all for today's episode of the DX Today podcast. Thanks for listening, and we'll see you next time.